If you're new here, I'm glad you're tuning in today because we're diving into a topic that confuses a lot of beginners but holds huge potential for those who take the time to understand it, and that's buying options. In this video, we'll go in depth on what options are, how strike prices work, how premiums are calculated, and when it makes the most sense to buy a call versus a put. We'll also talk about some simple strategies you can use, common mistakes to avoid, and how to choose strike prices and expiration dates that fit your trading goals. Whether you're just starting out or you're already trading stocks and looking to step into options, this guide will help you lay a solid foundation. So let's get started. To begin, let's talk about what an option actually is. An option is a financial contract that gives you the right, but not the obligation, to buy or sell an asset, usually a stock, at a predetermined price within a specific time frame. There are two main types of options, call options and put options. A call option gives you the right to buy a stock at a certain price, while a put option gives you the right to sell a stock at a certain price. The key thing to remember is that you're not buying or selling the stock directly, you're buying the option to do so, which gives you the flexibility to profit from price movements without owning the stock outright. Now, when you're buying options, you're entering what's called a long position, meaning you're paying a premium upfront for the chance to profit if the stock moves in your favor. You're not obligated to exercise the option, but you've paid for that opportunity. And that's what makes options so powerful. You can control a large number of shares for a relatively small cost. But this also makes them risky, because if the stock doesn't move the way you expect, or doesn't move quickly enough, the option can expire worthless, and you lose the entire premium you paid. Next, let's get into one of the most important parts of an option contract, the strike price. The strike price is the price at which you have the right to buy or sell the stock, depending on whether you're holding a call or a put. Think of the strike price as your target. If you're buying a call, you want the stock's price to go above the strike price before the option expires. If you're buying a put, you want the stock's price to fall below the strike price. For example, let's say Apple is trading at $150 per share. If you buy a call with a strike price of $160, you're hoping the stock moves well above $160 before expiration, because the higher it goes, the more profit you can potentially make. On the other hand, if you buy a put with a strike price of $140, you're betting the stock will drop below that level. If it falls to, say, $130, you have the right to sell it at $140, locking in a profit. Understanding strike prices is essential because they determine whether your option has intrinsic value. Options that are already profitable, meaning they're in the money, tend to be more expensive, while out-of-the-money options are cheaper but require a bigger move in the stock to become valuable. The further the strike price is from the current market price, the less likely it is to be profitable by expiration, but that also means the premium you pay is lower. So choosing the right strike price is a balancing act between affordability and probability. Now let's move on to premiums. This is what you pay to buy an option. The premium is the cost of the option contract, and it's influenced by a few main factors. The first is intrinsic value, which we just mentioned. If the option is in the money, meaning the stock price is already beyond the strike price, it has intrinsic value. The second factor is time value. The more time left until the option expires, the more opportunity the stock has to move in your favor, so the more expensive the option will be. This is why longer-dated options tend to cost more than short-term ones. Third is implied volatility, which measures how much the market expects the stock to move in the future. If a stock is expected to move a lot, like around earnings or big news, the premium will be higher because there's more potential for profit. Finally, things like interest rates and expected dividends can also play a small role in pricing, but for most beginner traders, the three biggest factors to focus on are intrinsic value, time value, and implied volatility. Now that we understand what you're paying for, let's talk about when it actually makes sense to buy a call option. A call option is a great choice when you believe the stock is going to rise significantly within a certain time frame. You're bullish, you expect upward movement. But not just a small bump, you want a meaningful increase that exceeds the strike price and covers the cost of the premium. Ideal times to buy calls include moments before a major earnings report, a product launch, a merger, or some kind of big announcement that could move the stock. Maybe technical indicators show a breakout, or maybe the overall market is trending higher and you want to take advantage of that momentum. Timing is critical here because options lose value over time, especially short-term ones. So if the stock moves too slowly, or doesn't move at all, you can lose money even if your thesis is right. That's why it's important to not only be right about direction, but also about the timing. Now let's flip it and talk about when to buy a put option. You buy a put when you think the stock is going to drop, and again, you want a significant move, not just a little dip. Maybe the company is facing legal trouble, or you expect them to miss earnings. Maybe the market as a whole is turning bearish. A put option gives you the right to sell the stock at the strike price, so if the stock falls below that level, your option becomes more valuable. Buying puts is also a smart way to hedge your portfolio. For example, if you own shares of a company but you're worried about short-term downside, buying a put can act like insurance. Just like with calls, the stock needs to move far enough, and fast enough, to justify the premium you paid, or else you risk losing it entirely. Now let's get into some basic strategies when it comes to buying options. The most straightforward is the long call. You simply buy a call option and wait for the stock to go up. This is a low-cost way to bet on a stock's upside potential. If the stock rallies above the strike price, you can either sell the option for a profit or exercise it to buy the stock at a discount. Your risk is limited to the premium you paid, but your potential reward is much higher. Then there's the long put, which is the opposite. You buy a put option and profit if the stock goes down. This is useful when you're bearish or want to hedge against downside. Another strategy to consider is buying LEAPs, which stands for long-term equity anticipation securities. These are options with expiration dates over a year away. Because they have more time, they cost more, but they also give your trade more breathing room. This is a good option, no pun intended, if you believe in the long-term direction of a stock but don't want to commit to buying shares just yet. You can also buy options before events like earnings reports if you expect a big move, but remember, options often get more expensive ahead of earnings due to rising implied volatility, so the stock needs to move significantly to make the trade profitable. Let's talk now about how to choose strike prices and expiration dates. These two choices can make or break your trade. If you're a beginner, it's usually best to stick with options that are either at the money or slightly in the money. These have a better chance of becoming profitable because the stock doesn't have to move as far. Out-of-the-money options are cheaper, but they require bigger moves to become valuable. As for expiration dates, shorter-term options are cheaper but riskier, because there's less time for the stock to make a move. Longer-term options cost more, but they give you more flexibility. A good rule of thumb is this: if you're confident about a quick move, go short-term. If the timing is less certain, go longer. Now we need to be real and talk about the risks of buying options. The biggest risk is total loss of premium. Unlike stocks, which can go up and down indefinitely, options expire. And if your option expires out of the money, it's worthless. You lose 100% of what you paid. That's why timing is so important. Another risk is emotional trading. Options can be volatile, and it's easy to panic when your trade is temporarily down. That's why it's so important to plan your trades in advance, know your entry, your exit, and your risk tolerance. Never put in more than you're willing to lose. Think of options as tools, powerful tools, but tools that can cut both ways if used carelessly. Let's walk through a quick real-life example to tie everything together. Say Tesla is trading at $250. You buy a call option with a $260 strike price, expiring in 2 weeks. You pay $5 per share, or $500 per contract. If Tesla rises to $270, that option is now worth $10, or $1,000. You've doubled your money. But if Tesla stays flat or drops, your option might expire worthless, and you lose the $500 you paid. This is why direction, magnitude, and timing all matter when buying options. It's not enough to be right, you have to be right fast. To wrap this up, buying options can be an amazing way to take advantage of stock moves without putting a huge amount of capital at risk. But they're also risky, and they require a solid understanding of how they work. Focus on learning the mechanics, practicing with paper trades, and starting small. Understand the strike price, pay attention to expiration, and respect the premium. Don't chase trades, and don't gamble. Use options as a strategic tool, not a lottery ticket. As you grow more confident, you can start layering in more advanced strategies, but mastering the basics will take you a long way. Thanks so much for watching. If you found this video helpful, make sure to like and subscribe. And let me know in the comments, do you prefer buying calls, puts, or something else entirely? I'd love to hear how you're using options in your own trading journey. Be sure to check the description for free resources and tools to help you level up. Until next time, trade smart, stay disciplined, and keep learning.